Joyce, what's your macro outlook for the rest of the year? I know it's tough because who knows what to believe when it comes to the data.
Right, exactly. At American Century, we think that we are likely headed for an economic slowdown in the back half of this year. Now, the recent data releases around the jobs and things like that really haven't changed our opinion. We actually had this view that the slowdown was going to slowly play out through the hard data towards the end of the summer, which is exactly what we're seeing now.
Okay, so you foresee a slowdown. What does that mean for the fixed income market?
So luckily, fixed income, it's very favorable for fixed income just because we do see interest rates holding steady in the intermediate to long end. The short end is likely to fall if the Fed does cut 1 or 2 times, as we are expecting.
And the Fed is waiting for information on tariffs, and who knows when and if they're going to get it. So how do you see the whole tariff episodes unfolding?
Yes. So right now, it seems like on average, we are settling between 15 and 17%. Obviously, not all of the deals are finalized. But I think the worst case scenarios from Liberation Day have been largely avoided. So that's rather positive. So you saw the whole rally up until a couple of days ago. But, we do believe that the tariff uncertainty is closing. And so the inflation story will start to become more clear. And we think that's going to pick up a little bit towards the end of the year, unfortunately, kind of in time for Christmas shopping.
How hard is it for the Fed to make a decision about rates when right now there's questions not only about the data, but there's questions about those tariffs?
Yes. So that's why the Fed's really between a rock and a hard place right now, because the jobs report obviously shows there is some weakening in the labor market. But at the same time, inflation is still above the 2% target and, as we mentioned, likely to increase a little bit further from here.
So where are the best opportunities? What are you telling your clients over at American Century?
So at American Century, we suggest that clients in the fixed income market really stay kind of in the shorter duration area because you're getting really good absolute yields in fixed income. And in the short duration area, you're likely going to benefit from falling rates, and you're not exposed to potential rising rates in case inflation does pick up a lot further from here.
You're still getting a nice yield in cash, money market as well. So why not just stay there instead of going out and buying some bonds?
Yes, that's what a lot of people I've talked to over the summer have said, up until we got that disappointing jobs revision number, right? So if the Fed does cut, the cash rate, CDs, T-bills, cash and cash equivalents are all going to drop pretty much 1-for-1 with the Fed rate. And so in short-term bonds, you actually will get higher total returns given the duration effect, plus the yields won't be affected as much.
And in which particular products are you steering clients? Is it municipal bonds? Is it treasuries, high yield, corporates? What are you telling them to buy?
We believe that it's best to be in a multi-sector opportunity on the taxable side. So there's opportunities in corporates and securitized, even emerging market debt. But it's hard for people to time sector rotation the best. So we manage the funds actively, and we think that will result in the best outcomes. On the municipal side, we've seen munis on sale for the first half of the year. We do think it's a good time to look at munis as well.
And then finally, everyone's watching that 10-year and they're watching the auctions. So what are you watching when it comes to treasuries?
Yes. So like I mentioned, we believe that the 10-year is likely to remain range-bound 4 to 4.5%, depending on how bad the economic data goes. It might go lower to that range. But as we saw during Liberation Day and kind of the worst of that news, the 10-year didn't breach 5%. So we do believe that there is some chance the 10-year could move up a little bit, but largely it'll remain where it is.
All right. Well, thanks for coming on and talking about it.
Thanks, Greg.